Welcome back to episode 17 of the $100 to $10,000 series, where I invest $100 every month to the Vanguard S&P 500 ETF until it grows to $10,000, to show everyone that investing doesn't have to be complex. This week, we are up 0.78%, and overall, we're up 20.12%. Unless you are invested in an ETF like the Vanguard ETF we are investing in our series, or have someone else take care of your money for you, you're going to need to do research on the companies that you invest in. And one of the first places you start is by looking at the company's financial statements. There are three basic parts to a company's financial statement. The first, which we will go over today, is the income statement, which basically shows us how much money a company is bringing in and how much it's spending to make those profits. The other two are the balance sheet and the cash flow statement. And I will cover those in future videos, so make sure you are subscribed with the bell notification icon turned on. So for this video, we are going to use Tesla's income statement to learn the basics. So to find any company's income statement, you can just Google the company's name and then type income statement. And Yahoo Finance or a similar site should show up with the information. So the top row always starts with the company's revenues, which is all the money that the company brings in by selling its products and services. And so when you hear someone say top line growth, it means that the company's revenues grew. Tesla obviously makes the most money by selling its vehicles, but it doesn't just make money from selling its cars. It also makes money from selling solar panels and leases as well. So if you want to look in more detail at where they made money from, then you can find that information in their annual or quarterly reports to the SEC. And the columns on the income statement separates the revenues by year or quarter, and we see this weird acronym that some of you might not be familiar with. TTM here stands for trailing 12 months. The reason why trailing 12 months is important is because it compares the most current information with the same time 1 year ago. So it allows us to compare how much money the company grew or declined in the past year. And for companies that do well in certain seasons and not so well in others, the trailing 12 months allows us to make a suitable analysis. For example, Six Flags, which makes most of its revenues from operating its amusement park, is a very seasonal business with the most people coming in during the summertime and its business falling off in the winter as the weather becomes more chilly. So we don't want to compare Q2 results with Q1 results. Instead, what we want to do is to compare its Q2 results with the Q2 results 1 year ago. Alright, going back to Tesla's income statement, the next items that we see are the cost of revenue, which is how much the company spends on manufacturing and delivering its products to the customers. So this would include the material costs associated with building all its vehicles, the labor costs to build the cars, and the costs associated with delivering the vehicle to the customer. There is a similar metric to the cost of revenue, and that is the cost of goods sold, often abbreviated as COGS. These two may seem like the same thing, but cost of goods sold only includes the costs associated with making the product itself, but does not include costs outside of manufacturing, like marketing costs. So you can think of cost of revenue as a more comprehensive metric to measure how much it costs the company to make and sell its product to the consumer. And COGS is included within the cost of revenue to show us a more focused view on the cost associated with manufacturing the product sold. And on the next line, we have the gross profit, which is how much money is left over after we deduct the cost of revenues from the total revenues. So in Tesla's case, in the last year, we have $25.7 billion in revenues, minus the $20.6 billion in the cost of revenues, which gives us a profit of $5.08 billion. And from this number, we can calculate the company's profit margin. So we would do that by taking the total profit, which is $5.083 billion, divided by the total revenues, which is $25.708 billion. And that gives us a profit margin of 19%. And if you are researching a company to decide whether you are going to invest in the company or not, it's usually a good idea to compare the company's profit margin with a similar company or a competitor to see how efficiently the company makes its products. And next we have the operating expenses. These are costs that are not directly related to manufacturing the product. And if we expand this tab, we can see that it's broken down into two larger groups for Tesla, which is the selling, general, and administrative costs and the R&D costs. The SG&A costs include things like salaries of department staff like HR and marketing, advertising fees, and rent and utilities. And R&D expenses are costs related to developing new projects. And so our total operating income for the last year comes out to be $1.2 billion. And we got that number by taking the gross profit, which was $5.083 billion, and subtracting with the operating expenses, which was $3.865 billion. And some people mistakenly think that gross profit is how much the company has left over with all its expenses paid, but that's not true. It's actually the operating income, because the gross profit does not take into account the operating expenses. So operating income is how much money the company is really taking home before taxes and interest payments to either distribute to shareholders in the form of dividend payments or to reinvest into the company. The last item we should pay attention to is the net interest income. This is how much the company spent or earned from interest payments. For example, if a company borrowed money from the bank or another company, they need to pay interest on their loan. And that interest payment would be taken away from the company's net income. On the flip side, if the company lent money to another company, then they would be paid an interest income. In Tesla's case, their interest income was $43 million, but their expenses were $694 million. So their net interest income becomes negative $651 million, which just means that their net interest income is not an income, but an expense. So to calculate Tesla's final pre-tax income, all we have to do is take the operating income of Tesla, which was $1.218 billion, and subtract it with the net interest expenses, which was $651 million, and then add in this other income expense of $3 million, and we get the pre-tax income of $570 million. And taking what we've learned today, we can see that there has been a rapid improvement in Tesla's income statement. First, we see that the top line has been steadily growing, and that its gross profits and its operating income has been steadily growing as well. So just by looking at the growth in the total revenue, the growth in profits, and the operating income, we can tell why the stock has been doing so well recently. That's going to do it for this video. If you enjoyed, please leave a like and subscribe with the notification bell icon turned on, and I will see you guys in the next one.